very careful to balance out the strike between maximising your borrowing power and protecting your future from potential risks.
So the banks like to cross-collateralize your properties. They can make it very sticky.
Different valuers tend to value properties differently, and depending on who you speak to, you could end up with completely different valuations. Today I've brought in one of my seasoned veterans. Gab, he's helped over 1,000 customers throughout his time buy properties using the equity inside their home or their current investment properties. So let's start with the fundamentals. How do people actually determine how much equity they have in their property?
I suppose the easiest way to look at equity is by looking at the property value. So you have $1 million property value, you have a $500,000 loan. The difference of that is your equity position. So therefore, 500,000 equity.
Yep. So when people say, I've got 500,000 equity, how much of that 5,000 can they actually use, and how do they actually use it?
So if you're buying without a thing called LMI, lender's mortgage insurance, then you can tap into up to 80% of the value.
Yeah, so this comes down to everyone's circumstances, but in a general rule of sense, the banks want to see that they still hold 20% of the equity and you can leverage up. So what we've been finding in our careers is that people just extend that mortgage up to 800,000, right? Which means that you're gonna pay a mortgage on 800,000. But we do it a little bit different. We always try to obviously split loans for purpose. So we try to split the loans in a sense that it allows you to differentiate if one portion is tax deductible for one property, and fit for purpose, the other taken out, that's going to be used for another purpose or even multiple purposes, and we could even further split that. Is that correct?
That's right.
With, I guess, working out how much equity you have, how does the bank determine the value of the property? Or how do you determine the value? Do you go to a real estate agent? What happens?
So each bank will run a valuation differently.
So one thing that we've noticed in our careers, I guess, is different valuers tend to value properties differently. So different banks even have different systems and different mechanisms, and depending on who you speak to, you could end up with completely different valuations.
That's correct. Some funders you can run valuations upfront. Some they need it if you do an application. So it depends on which fund you go to.
So let's maybe give an example of a situation which we've had with customers. We've had a customer who came to us, they were talking to another broker, they were asking about how they could buy their next investment property. That broker put in an estimate for their property, 800,000. We knew the property was worth probably closer to $1 million, right?
Yep.
And they put a proposal to the customer to take mortgage insurance, pay extra money, take a higher rate of interest in order to buy the property.
So what we did was we were able to look at the valuation or run multiple valuations with funders and get the highest valuation to extract equity up to 80%. So there was no LMI for that client.
So, Gabs, what happens when they've valued the property? Okay, so we've picked a bank or lender and they've given us a really good valuation. What happens then? So essentially the equity release, it creates your deposit, your costs, the whole, back to the original rule of obviously buying a property of 20% deposit, borrowing 80%, you'd create the 20% plus cost through that equity release. Yes. You might not use it all. It depends on whatever your goal is with the next property is. Yep. That will essentially serve that purpose.
Of course, and you also have to determine if you can actually service that additional loan as well.
So look, it's all well and good to take equity out, Gabs. Tell me, if you just walked into your bank, wanted to draw equity, buy an investment property, they might not even tell you to draw equity. They might just say to you, hey, you can borrow $1.5 million, right? And you've got an existing property. What are they essentially doing there?
So the banks like to cross-collateralize your properties. So what that means is you've got property A and you've got property B, and they say instead of releasing equity on property A, we're just going to combine the properties together, and therefore we'll give you maximum property value of the combined properties. So it can make it very sticky, very hard to release equity. If certain things happen to one property versus another property, then it could impact you, taking out equity from property A. It's very important not to cross-collateralize properties.
So essentially, look, to give you, maybe we can talk about an example. I've had a customer who, they really wanted to buy a family home. They had made a very, very poor decision quite some time ago to buy a house that was overpriced massively in a mining town during the mining boom, right? And they crossed that into their family home at the time, which was a 2-bedroom unit. Now they're in a state where they've, their incomes have increased, they've saved some money, and they go, why can't we just sell our unit and upgrade? But they couldn't, because the value of the first property dropped down so dramatically that if they sold this property, they wouldn't be able to hold the debt facility, let alone reduce that loan to the amount that's required by the bank to release even their property, so they're stuck. So this is a huge problem with cross-collateralization. Something we will never do. We will never do to any of our clients if there was no reason to do it. Once in a while, there could be a reason, but essentially, if you can avoid it at all costs, right?
So for example, if you had a $500,000 value and you had a $400,000 loan linked to that at 80%, obviously, if there was another property bolted into that, right, and the value went down to 400, so you got pretty much 100% loan, in order to remove or to like uncross those properties, you'd have to like almost pay an additional like 80 grand off that just to remove that property. If that makes sense, right? So $500,000 property goes down to 400, but that's your loan. So it's 100% LVR. That can stay at that bank if it was separate. But if it's cross-collateralized, you'd have to reduce it to 80% in order to take it out.
That's true. Let's maybe talk about other things. Like, so there is a lot of people who release equity for different reasons. Obviously, don't take equity out for personal reasons if you can avoid it, right? If you do, don't go and take out 400 grand and go buy a Lambo or go to the casino or whatever. It's, essentially we want to be taking equity out for a purpose.
Yeah.
So equity out, ideally, the risks of taking equity out, if you're not using it for a great vehicle or not buying the right properties, can be quite risky, but you got to make sure that you have the right people around you, getting the right advice, buying the right style of property, using that as a vehicle to create more financial freedom, essentially. But yeah, as once in a while, people do find themselves in situations where they've accumulated a lot of bad debt, credit cards, personal loans, you name it, right? What do we do there?
You can release equity to debt consolidate. So if you had a credit card and you just couldn't get above the repayments, it just kept smashing with interest, then you can release equity to cover, like to clear those debts and reduce you back down to a certain breathing space. Because credit card debt, personal loan debt, sometimes the rates are a lot higher than a mortgage debt.
So let's talk about the benefits of obviously using equity versus using their cash to buy a property.
So I've actually got a client who purchased 2 investment properties using cash from his offset that was offsetting his non-tax deductible debt, so his own occupied loan. And I said to him, what happens if you're using, right? So I'll give you an example, $1 million property, I love the $1 million property, $500,000 loan, $300,000 in the offset. He used the $300,000 to purchase a property versus either A, extracting equity, or B, debt recycling. So he just used the cash. So basically, if you take the money out of your offset, what happens to your own occupied loan?
He's now paying interest on $500,000.
Correct.
That's non-deductible.
And what was he paying before?
He was only paying interest on $200,000.
That's right. So I explained to him the benefits of debt recycling and making sure that he understands that he should have actually taken the funds from his offset, put it onto the loan to reduce his non-tax deductible debt down to $200,000, then redraw it back out into the offset, and then use that for investment purchase.
Yeah, so you're either redrawing or reborrowing, right? So essentially your investment property becomes fully geared or fully tax deductible for all of the loans, and your non-deductible or your what we call your own occupied mortgage portion or non-deductible portion is reduced. So yeah, I've personally used this myself throughout my career, and I've essentially done it on maybe 5 or 6 of my own properties, and it's allowed me to pay off my house that way.
It's key. It's critical.
Yeah, very critical. So I guess the key point of that conversation is about who is actually talking to you about these things, the importance of a good mortgage broker to talk to you about the structure, the strategy before you make the next transaction.